name is Martin Jones, and this is P2 Corporate Reporting. To prove the fact, I have a slide just behind me. I'm going to go mini-me right now. Which way do I go? This way. There it is, over my shoulder. Oh, that feels slightly weird. I think the camera might have reversed its angles. Well, that's all right. I can cope with that. So as you can see, there is my email address for your direct communication with me and confirmation that we're doing ACCA P2 together with me, Martin Jones. And as you can see, I'm on a very slidey, rolly chair as I was on Tuesday. Today's Thursday, by the way, for those of you watching this as a recorded fella. So let's wake up this slideshow. Where's my pen gone? It was there a second ago. Where's it gone? There it is. Oh, nice. Wake the fella up. There we go. So we're on session 5. But as you know, I like to just remind you of what you have done so far and sort of build. So on the first session, first afternoon, we did basic groups, and we followed that up with complex groups, you know, parent by sub, sub by sub, sub. And at that point, pretty much all of the major groups issues were covered actually by the end of session 2. But we augmented our group's knowledge by looking at foreign subsidiaries. But not only did we look at foreign subsidiaries, we looked at foreign transactions more broadly, and then moved on to cash flow statements. Cash flow statements are considered part of the groups section of the syllabus, but actually cash flow statements are really very different to P&L and balance sheet. P&L and balance sheet is done by the process of adding across. The fancy name for adding across is consolidation. So P&L and balance sheet are adding across their consolidation questions, but cash flow statements are done by that process of cash flow statements. The technical name for what we do actually is, I'm not sure, I seem to have stumbled into this. I'm going to say it now because I seem to have stumbled into it. But the technical name for what we do is actually called incomplete records. We work out the cash flow as a missing figure in a flow of numbers. Those workings that we do, they're a technique called incomplete records actually, which is, did you just study that when you did F3 1,000 years ago? I did 1,000 years ago. So cash flow statements are done by, technical name for what they're done by is incomplete records. They're done by cash flow workings. Very, very different thing. And thinking of different, you can't get much more different than current issues. The examination's made up of 4 questions. Question 1, you have to do it because it's compulsory. Questions 2 and 3 are the techie questions where you get written stories and you respond to these written stories you discuss, and they're both pretty hard. Usually one of them's hard and the other one's ridiculously hard. So you don't want to be doing both of those, which pushes us to question 4, which is current issues. Now current issues questions, generally speaking, are not easy, but they are generally easier than the other 2. So you'll almost certainly be doing current issues. Because you'll almost certainly be doing current issues, I introduced it early in your learning. So you could start reading the Ivory Tower articles in chapter 5. So to read the Ivory Tower articles, you don't need to go anywhere apart from chapter 5. Go into chapter 5 and have a look at the Ivory Tower articles. That will do the job for you. Then we start, that was session 5 was recorded actually on Tuesday. Today's Thursday, so 2 days ago. And we started doing the proper financial reporting, you might call it. And this proper financial reporting pervades the whole paper. So, it's very common to get provisions in questions 1, 2, 3 and 4. But the way that the subject matter gets examined changes from question to question. I did this with you actually in session 4, but today is session 6, isn't it? Today's session 6 actually. Today is session 6. But today in session 6, session 6, is that right? Yeah. Today is session 6 where we go into other standards and non-current assets. And impairment, for example, is in non-current assets. And that very frequently gets examined in question 1, 2, 3 and 4. So it's really common. But what happens as a subject moves from question 1 to 2 to 3 to 4 is the way that the subject matter is examined changes. So if you're doing impairment, I was talking about, wasn't I? If you're doing impairment in question 1, you're bashing the numbers. If you're doing impairment in question 2, you're regurgitating the knowledge. If you're doing impairment in question 3, then you're analysing a scenario with an impairment and commenting upon that scenario, analysing that scenario. And if it comes up in question 4, if impairment comes up in question 4, you talk about the problems with impairment. The problems being called current issues. So the subject of impairment comes up everywhere. The subject of, contingencies comes up everywhere. The subject of control and groups comes up everywhere. It moves across the paper. All subjects move across the paper, but the way that they get examined changes from question to question. That's the way that P2 is constructed. So coming back to that thing about question 4, is really, really important. You get the psychology of question 4 before September. You almost certainly will be doing question 4 in September, but you don't want to you don't want to be doing the question by default. You want to feel positive about the question. You want to say, I want to do question 4 rather than, oh, I do have to do question 4. The more positive you can feel about the question, the better. And the way to feel positive about question 4 is to 1, read the ivory tower, and 2, practice the question value in chapter 5. So read the articles in chapter 5 and practice the question in chapter 5. Just stay in chapter 5 is all you need at this stage. And what you'll do there is you will set yourself up with a general feel for current issues that I will then be able to work on in the revision phase. There's a big part of the revision phase is getting you really good at current issues. But if I start you from 0 in current issues, you'll really struggle. So if you can get yourself up onto the first step on current issues, that makes a massive difference. Well, that was a long introduction. I wasn't expecting to make such a long introduction, but it naturally flowed off my tongue, so I didn't stop it. So you can see over my shoulder what we're doing today. We're doing other standards, which is a bit of a naff title, isn't it? But there's probably not much else you can call this stuff. It's all the baby standards, like contingency accounting and events after the reporting period and that sort of stuff. And then there's a nice block of non-current asset stuff. But actually this block of non-current asset stuff is fairly bitty. So there's a bit of, I teach you this, you go, yeah, I get it, and then we move on. And then I teach you the next thing and you go, yeah, I get it, and then we move on. There's lots of little bits to learn, lots of learning to learn. Let's start. So David has set me up today, and he's actually left me with the note that we did together when we were together, last time we were together. And as you can see, we've got held for sale here, and there's the question on provisions. Looks a bit odd actually, flicking past you like that. I think I might change the scale so you can really see it. So I'll just wind up to page 1 of the provisions. There we go. There we go. I'm sure you remember this question, the wonderful question, oil rig. So that's basically where we left it when we were together. And that means that we're in the notes. Oh, the notes have wound back right back to the beginning. So here are the class notes. There we go. We should have got the right one, September, December. And then we go down to the chapter on provisions, chapter 6. Have I said that right? Chapter 7. There we go, there's the performance stuff. There we go, there's provisions. Chapter 7. And you can see now that the title is Provisions and Other Standards. Provisions accounting is not really that complicated, is it? Spot the roo, good eye. You've got the 3 criteria. You need a reliable estimate, an obligation and an outflow. Spot the roo. Or if you prefer, spot the rot, whichever you prefer. There's 3 criteria and that's all there is to it. So provisions accounting is not really that complicated, but it is really, really, really common in the exam, which is why I put quite a lot of effort into provisions accounting. But there's some other equivalent, not particularly complicated, but fairly frequently examined standards that we need to learn, and I've blocked them off as being other standards. And they start with contingencies accounting. Contingencies accounting uses this table, and as I've got a nice lie back kind of a seat here, I'm going to stretch my back like a naughty student at the back of the class, and I can barely see that, but I can just about make it out. Contingencies uses this table here, and there's no doubt about it, the examiner is very particular in what he likes to examine. You can see the 6 blocks in the table. No, not 6. He doesn't like to go for 6. He's got a real obsession with this top block there. And as long as you've got the top block, you've pretty much got the subject. So there you go. Probable contingent liabilities, you provide for them. Probable contingent assets, you merely disclose. And that's it, really. That's the whole subject. Dead easy. You now know it. What should I do here? I do feel like doing the question outrageous. Sometimes it can get a bit dry here in the studio if all I do is just tell you stuff rather than show you stuff. So I'll go that extra half mile and I'll show you stuff. So contingencies. This is a bit close to me. Just give it a bit of space so I can spread out. Ooh, the pen's working well today. Welcome, guys. Hello to Punit, hello to Ridwan, hello to Zuberi. Same 3, my 3 musketeers. Who was it? It was in the last background last time. Was there a Greg in the background? There was someone in the background, wasn't there? Are you there, Mr. Background? What I'd like you to do, guys, all of you, is tell me, what am I highlighting now? What am I highlighting now? Excellent, good. And no delay at all. So you just do my usual there, making sure everything's coming through nice and clear. And it clearly is coming through nice and clear. So the question is outrageous, which is a very common part. It's a light that's a bit awkward for me. It's probably going to drive me nuts if I don't just think about it straight away. It's designed to light up the background. If you're familiar with this kind of studio work, you'll probably guess that actually behind me is not my notes, of course. It's a green screen, and in order for a green screen to work, it needs to be brightly lit. And like I say, a green screen to work, it needs to be brightly lit. You don't want that in your eyes. Oh, goodness me, I did a good job there. And the green screen's still working well. Flipping heck. That was a very good job. Well done, Mr. Jones. So, let's go and have a look at this question. Outrageous. A newspaper accuses a public figure of being mafia, even though they know this is not true. The public figure sues, and both sets of lawyers agree that it is likely that the public figure will win the case, and receive damages in the order of 1 million. There is no possibility of the case being resolved before the financial statements must be finalised. And this is the thing, you see, the examiner is very fond of examining probable contingent liabilities and very fond of examining probable contingent assets. But what he's most fond of is examining both in one question. And we're going to do both by looking at both entities. We're going to look at, first of all, the newspaper and then the public figure. The newspaper has the potential outflow and the public figure has the potential inflow. So the newspaper has a probable contingent liability. And using the table, we can see that therefore the newspaper must provide the public figure has a probable contingent asset and so must disclose, which means not provide. And if this came up as question 3, your answer would just look like that for a 2 marker. Zuberi's just asked, would this be a 7 marker? Could you get a 7 marker on contingencies? Absolutely no chance. But you could get a contingent liability in a story that's got 7 marks. So you might get a story that's got a building falling down, and that affects the depreciation, the impairment of the building, the revaluation gains, but also when the building fell down it did some damage to some individuals and they might sue, and therefore there's a contingency as well. So you'd never get a 7 marker on contingencies, but you very often get 1 or 2 marks on contingencies in a bigger scenario that is 7 marks. So you might get, you know, deferred tax revenue recognition and a contingency sort of slapped on. And if this came up as question 3, you know, or question 2, which is where it comes up most commonly, then that would be the end of your answer. But if this came up as question 4, the examiner would be looking for you to criticise what you've just done. You do this, but your final point in question 4 would be, that's inconsistent, and therefore there's a problem with IAS 37. Enough said, let's move on to the next subject. So the next subject is events after the reporting period, and they can get pretty techie if you use the table just as it is. I think I better roll back and do my, sort of bad boy sitting at the back of the bus kind of a thing. There's 2 different classifications of events after the reporting period. There are those events that give evidence of a condition that existed at the year end, and those events that do not give evidence of a condition existing at the year end. They're completely unconnected to the year end. It's a bit of a mouthful, really, to be honest with you. Events after the year end are discoveries generally. But what's important is not the discovery of the problem, but the original problem itself. For example, if you discover a flood, it's not the timing of the discovery of the flood, it's the timing of the flood itself. If you discover that one of your customers is insolvent, it's not the timing of you discovering that your customer is in trouble, it's the timing of when they got in trouble that matters. And if the trouble was before the year end, then you'd write off the debt as bad in the current FS. And if the actual underlying problems that the customer had happened after the year end, and the customer was fine at the year end, then you leave the customer on the balance sheet, you leave the receivable untouched. That's the basic idea. And the technical name for the technique that I'm using here is the technique of the underlying event. These stories always describe discoveries, but it's not the timing of this discovery, it's the timing of the underlying event. And we're going to use that logic here with the question fraud. ERP, as they're always called, events after the reporting period, or sometimes still known as PBSE, post-balance sheet events. ERP is the proper name. So the question is fraud, isn't it? I just saw that title a moment ago. Again, very, very common for 1 mark somewhere in the exam. Rarely 2, but you know, pretty common for 1. And usually it's either a adjusting or non-adjusting ERP. I've deliberately written this question, so it's actually both. 3 weeks after the year end, internal auditors discover a fraud. So the ERP is the discovery. ERP. The discovery of a fraud is an ERP, and the abbreviation is absolutely fine. It's a standard abbreviation. The accounting will be based upon the timing of the underlying fraud itself. The accounting will be based upon the timing of the underlying fraud. So timing, the accounting is as follows. Obviously I'm cheating, I've done this question before, so I know what's coming up. And what we have is one thing happening over a continuous period, some of which was before the year end and some of which was after the year end. So we've got before year end and after year end. And that gives us the 2 different types of, that gives us the value and the 2 different types of ERP, and therefore the 2 different forms of accounting. I think that table's going to make sense. So let's have a look at the story again. Here we go. So the finance director has stolen 30 million from my bank account, 10 million before the year end and 20 million after. The theft, of course, is unreflected in the draft FS. So it was 10 before and 20 after. The money that was stolen before the year end was stolen before the year end, and that money that's on the bank in the draft FS on the balance sheet isn't actually in the bank, and therefore we need to pull that 10 million that isn't there out of the FS. So that's an adjusting ERP, and you know the accounting you do from adjusting ERP, very simple. You make an adjustment. Adjustment. But the 20 million that was stolen after the year end was in the bank account at the year end. And saying it wasn't in the bank account is a lie. It was in the bank account. So you can't adjust. So events when you can't adjust are called non-adjusting ERP. You don't adjust because the money was in the bank account at the year end, but you don't ignore it either because it's useful to communicate with shareholders. So you do what's called disclose, which means make a note. Oh, I've got a very sore throat. Tickly sore throat. Oh, not good when I'm just starting off, is it? There you go, that's what you do. Next subject. Okay, so the next subject, related party disclosure, very simple idea. Yeah, you know, not much to this. Transactions between parties related by control or influence are disclosed. Transactions that are related by control are strictly called common control transactions. So, you know, they tend to be things like transactions between fellow subsidiaries. It's a bit skinny. That's not what I wanted. There we go. Transactions that are between parties related by influence tend to be with directors. Could be either way around, you know, could be the director lending to the entity, it could be the director borrowing from the entity. It tends to be lending and borrowing. Really, really common, comes up for 2 marks, you know. It's classic CACA actually. CACA is the idea that you whack down the knowledge, then you apply it, then you whack down the knowledge, then you apply it. So what you do is if a related party transaction comes up, you whack down the heading, related party disclosure, then you say transactions between parties related by control or influence are disclosed, and then you apply it to the scenario. You say this director is related to his entity, he's taken the money, and therefore the transaction needs to be disclosed. And there you go, you score the marks. Great. To be honest with you, the question cheated is a little bit overcooked because it's far more complicated than generally comes up in the exam. But it is based on a past exam question. So we'll have a go at it. Cheated Private Limited Company is a 70% owned by its Chief Executive Director, Mr. Cute. Mr. Cute is married to Mrs. Cute, who owns 100% of Cheeky, a private limited company. Cheated is a garage business and services Cheeky company cars for free. So we've got RPD, strictly speaking, is the name. And as I say, this question cheated, possibly overcooking it slightly. Because the relationships are actually pretty complicated. If the relationships get complicated, then do draw out a picture. It's very unlikely to happen, but if you do get something as complicated as this, draw a picture to show the relationships. Mr. and Mrs. Cute, they are married, and Mr. Cute has ownership, 70% of Cheated, and Mrs. Cute has ownership of Cheeky, if I remember correctly, and that was 100%. But these black words, 70% married and 100%, they are, the technical name for these things is called the legal form. And what we don't want is the legal form, what we want is the underlying substance. And the fancy name for the legal substance, sorry, I do apologise, the fancy name for the commercial substance is control or influence. So what is the relationship between Mr. Cute and Cheated? That is control. Mrs. Cute, that is control. Now, of course, we don't know the relationship between Mr. and Mrs. Cute, and if they are separated and living in different houses, not talking to each other anymore, then there's probably no relationship at all. But the exam question is not going to give you any detail, and you are permitted to make reasonable assumptions. I'm going to assume that they are still in love, and therefore that there is influence from one to the other. I slightly overcooked that arrow. Let's just get a bit of, there we go, a bit more control of it. So I'm going to assume that there is influence. I haven't left myself much space. So the effect of this is that there is an unbroken chain of control and influence in the background between these two. So cheated and cheeky, cheeky and cheated are related. But actually cheated and cheeky being related is completely irrelevant until they transact. And they have done. What's this thing doing? Wake up. There we go. There is a transaction where cheeky pays cheated nothing, that's the right way around, and cheated gives cheeky a car service. And that's it. The transaction is a related party transaction because it's a transaction between related parties. And the related parties are related by control and influence. It's actually two controls and one influence is what it is in the background. Okay, so this is a related party transaction, so requires disclosure. Or an RPT, rather cutely. The abbreviation's a standard abbreviation. You can use it any time you like. The transaction is an RPT. And so, cheated, we're looking at this from cheated's point of view. Cheated must disclose. A useful way of remembering this is that when you have an RPT, you must disclose TPR. That's rather cute, isn't it? TPR. You must disclose the transaction, the parties, and the relationship between the parties. There you go. And that would be plenty enough for an RPT question. And again, it's another one of those, not quite as common as ERP, but it does come up like once a year, and generally 1 or 2 or 3 marks, depending on how sophisticated this little story is. Finished. That's RPT finished. I've got a question from Punit, and I think he probably asked that question before I got to answer the question fraud, so I think he's sorted now. So Punit, just tell me sorted if you're sorted. Moving on to the next one. So the next subject, again, just a little one. Very, very strange, because not only is it a strange IFRS, but actually it's fairly commonly examined. Only a few marks, but fairly commonly examined. And the subject is agriculture. And yeah, that's right. There really is an IFRS on how to account for cows. There really is an IFRS telling us how farmers should recognise pigs. Yeah, Punit's sorted now, great. Biological assets, which means cows and pigs, but also means non-flesh, so apples and wheat and soya beans and that sort of thing. So farming assets are recognised fair value through profit or loss, FVPL. It's probably the first time you've seen that expression. Is it the first time you've seen that expression? Very, very common expression. Lots of things are actually recognised FVPL. Investment properties are recognised FVPL. Investment in shares are recognised FVPL. It's a really, really common phrase, very useful phrase, which means at fair value with gains and losses being reported through the profit or loss. It's a bit of a mouthful, that, isn't it? Biological assets are carried at fair value with gains and losses being reported in the profit or loss. Bit of a mouthful. The abbreviation, standard abbreviation, is FVPL. But there's a bit of a twist to FVPL. FV in this context means FVLTCS, which is, again, really a bit of a mouthful. Fair value less cost to sell. And the reason for this is, as it says here, the further that a cow is from a marketplace, the less it's worth. And this is a real thing for cows and pigs and apples. My wife was just talking about this recently, actually. The Japanese have this real obsession with apples, with high quality apples. And they have the ideal countryside, really, for growing apples, to be honest with you, which is, Japan is famously hilly. It's, in fact, enormously mountainous. And this works a sort of strange kind of magic with their apples, and what they look for is huge apples. They love massive apples that are really sweet and succulent. And if you can nail it and get a tree that's producing that kind of fruit, then you really have nailed it. And they have orchards all over Japan, and you know it's just the way that it works. Some of the orchards are quite close to the cities, but they don't necessarily produce the best fruit. The best fruit is then produced by the farms that are more distant from the cities. They're more in the more rural areas. But perversely, those better apples can be worth less than the apples next to the city because of the travel distance, you see. It is a real thing with apples. The further an apple is from the market, the less it is worth. It really is a real thing with apples. Whereas it doesn't matter with shares. If you're holding shares, you know, walking down the street in the centre of London, then those shares are worth just as much as the farmer who's holding shares up in Scotland. It doesn't matter where you are when you're holding shares, they all have exactly the same value. But shares and apples are not the same thing. The further an apple is from a market, the less it's worth. It's a real thing. And this is captured by IAS 41 by using this alphabet soup, FVLCTS. It's not really all that difficult. It's just something you need to get your head around. So let me convince you of that by doing the question cow. So here we go, let's go and have a look at cow. A cow is born to a farm early in the farm year. At the year end, the young cow is valued at 50 based on the price it would achieve in the distant market, but the costs to the market are 15. Discuss the effect of the above transaction on the individual FS of the farm. So how would the farm recognise this? The farm would recognise this by using what's called a movement in fair value. The farm would record the following. The gain is going to be a balancing figure. And I'll just put this in straight away. The closing balance, of course, goes to the balance sheet. And the gain, of course, goes to the P&L, FVPL, right? So what is the unborn cow worth at the beginning of the year before it's even born? I'm going to go for 0. What's the cow worth now? Well, if it was in the market, it would be worth 50, but it's not in the market. And it cost us 15 to get it to the market. So where is it in the field? What's it worth in the field? 35. And that's it. 35 is then a balancing figure and goes to the P&L. And you can see, you know, it's fine, isn't it? Punny, what you're asking is very very specific and very techy. Probably useful if you whack an email off to me to ask me that question. Right. Okay. Good. That's it. Farming sorted. And as it happens, so is the chapter. And as we turn the page and go for the new chapter, you'll probably think that things change, but they don't at all, actually. This bittiness continues with the subject of cost. Yeah, messy. Cost is just what, I mean, this is unbelievable, but it's absolutely completely true. It drives me nuts, and every time I get to this stage, my blood boils. But it really is true that cost is one concept, but cost is actually in two standards. It's completely mad, isn't it? But there you go. So PPE cost we're talking about particularly. PPE cost is direct costs, is the usual phrase for this, using financial management. So direct costs are capitalized, if I can turn that into a full sentence. So it's all costs that are directly related to getting the asset up and running, including the finance costs. And it's a bit mad, but the build costs are in one standard, that's IAS 16, but the finance costs are kept in another standard. It doesn't make any sense at all, but that's the way it is. That's the way the old ISB did it all those years ago. When was this done? Like the 1990s. The actual idea is not bad, but having it in two separate standards, that's mad. Anyway, here we go, supermarket. We'll carry on with this idea of whacking out numbers, whacking out little stories. So we're going to work out the cost of the supermarket by looking at the information. It's a bit of copying, to be honest with you. We're going to calculate the initial cost, and it's materials, labour, legal cost related planning, general legal costs, and apportion management time. Okay, so it's and that's our target. We're going to populate this little spreadsheet here. So we'll capitalise the cost if it's directly related to the building, and we won't if it's not. So a supermarket chain build their own supermarket costs are as follows. Materials and labour, 30 and 20, yep, they get capitalised. The legal costs related to planning permission is presumably the planning permission for this particular supermarket. So yeah, if it's directly related, then we capitalise it. But the general legal costs, I mean, it's not really very clear exactly what the examiner means here, and that's part of the problem with the exam questions. You never really know for sure exactly what the examiner is getting at, but he does seem to be implying that these are just general legal costs right across the whole group. They maybe include things like collection of bad debts and all sorts of stuff. No. You can only capitalise costs. You can capitalise any cost at all, as long as it's directly related to the supermarket. You can definitely capitalise legal costs, but only supermarket legal costs, only legal costs related to this particular supermarket. So we're not going to capitalise that. And it's the same with a apportioned management time. Well, the way that the examiner interprets this is apportioned means that someone's guessed as to how much of the management cost is related to this particular building. Now, we've got no problem at all with capitalising management. No problem. But not apportioned. It has to be directly related. Apportioned means made up proportion. If someone has done timesheets, then sure, we can capitalise their related costs. No problem. Management, anyone, if they've done timesheets, but if it's apportioned, no. And the problem is with apportioned, do you understand? If it had been apportioned materials, we would fail it. If it had been apportioned labour, we would fail it. The problem is with general and apportioned. We don't like general costs, we don't like apportioned costs because they're not direct. So we don't like general and we don't like apportioned because they're not direct. Let's put that there actually, let's do that. It's a nice way of saying it, not direct. Yeah, I like that. But we do like to capitalise borrowing as long as it is direct, directly related to building. Let's have a look at the story and about the building. A 10% loan for the 40 million was taken out for the full year. So the borrowing costs are 4 million. So 10% of 40 million is the borrowing cost. But we're not interested in the borrowing cost, we're interested in the borrowing cost that gets capitalised. But the building took only 9 of these 12 months to complete. So the cost that is related to the actual building is only 9/12 of that. Keeping this idea of direct costs only. So it's 9/12 gives us 3 and therefore 55. So that's the supermarket cost. Smashing, there we go, really good. Good stuff, guys. So very, very bitty. We just carry on like this. You know, it's the whole afternoon. It's going to carry on like this all the way up to the end of this session. Lots of little bits. Did you get it? Okay, let's move on. Just like that. So I'm happy with that. Hopefully you're happy with that. Let's carry on to the next component. So the next component is now we've got the cost. We need to spread it over the life of the asset. And oh gosh, yes, that is clever. Depreciation, exactly as it says, involves taking the carrying value and dividing by the remaining life. Yeah, quite clever actually. And that can be expressed as a formula rather than as a sentence. Can be expressed as a sentence, but probably better as a formula. Essentially speaking, this is depreciation. Depreciation matches carrying value to asset life and is reassessed annually. And this is the thing that the examiner likes to play with. It is very common in real life for accountants to work out the depreciation properly in the first year and then just repeat until the asset is dead. And that's not what the IFRS says. The IFRS on everything says measure what you measure in the first year and then do what you think is right in the second, and then rethink it again in the third. You know, keep your brain turned on. The effect of this brain turned on depreciation is to give a formula described in the sentence you just saw, where you take the remaining carrying value and divide by remaining useful life. So the examiner tries to catch you out with questions like oops, where he does 2 years. Or indeed he just does the second year. And let's have a look at oops and see how he tries to catch us out. So oops is a lovely question for, you know, testing if you got the idea. It's really easy to do, but it's also really easy to get wrong. It's deliberately designed to have a trick in it. Oops purchased a machine at the year start for 100,000, believing its life to be 10 years. At the first year end, the expected life is unchanged. Fine, okay, so the depreciation for the first year is as follows. So the cost is 100,000 and the depreciation in year 1, we just take 100,000 and divide it by 10 years and we get 10 and we're left with 90. And that's the opening carrying value at the beginning of our current year, which is the second year. Now, the way that the IFRS works is like this. What it's saying to you is, forget about that first year, just take what you got left and divide by what you got left. And if you do that, actually the answer drops out very easily. The great thing about this IFRS is you know you got it right if you get the answer quickly and easily. So 90 divide, you take what you got left and divide, oh, I haven't read what we got left. So however, during the second year, it is recognised that the original estimate of life was overstated and that there are only 6 further years of use, including the current year. So during the second year, we realise there's only 6 years of use left. So we just take the 90, divide by 6 years, and we get 15, and we're left with 75 as the current closing. Like that. And that's it. How could anyone possibly get that wrong, you ask? Well, the reason they get it wrong is because the examiners deliberately set this up with a trap. Can you see this reference to 7 years? The examiner is being a bitch here. He's trying to scratch your eyes out. So with hindsight, it appears likely the total life is 7 years. The point is, there is no hindsight. We do not hindsight depreciation. We just take what we've got left and divide by what we've got left. Take what we've got left and divide by what doesn't matter what happened in the previous years, forget about that. Just take what you've got left and divide by what you got left. So there is no 7 years, that's the thing. As long as you know there's no 7 years, then it's fine. But it is tempting, isn't it? That 7 there looks like you should do something with it. You do nothing with it, there is no 7. That's how depreciation works. Great. I better remove that redaction. There we go. Come on, fella, there we go. All done. Which brings us to the 2 biggies in this chapter. The 2 biggies being PPE revaluation and PPE impairment. These 2 are similar and they work very well with a sort of compare and contrast basis. Let's give myself a bit less space. Squeeze up a bit. because what I'm saying, a lot of what I'm saying is very simple, but it gets more complicated to work our way down. First thing is the direction, PP revaluation goes up, carrying value goes up when you have a revaluation, and when there's an impairment, the carrying value goes down. Pretty simple. This is just knowledge, but simple enough, and that is the performance reporting. Do you remember this? There are 5 things that go through the OCI. The 5 things are HEAPS, which is hedging, exchange, actuarial, and PPE revaluation. PPE revaluation goes through the OCI, whereas impairment doesn't, therefore it defaults through the P&L. So that's just a learning thing. PPE revaluation goes through the OCI. So going up goes through the OCI, going down goes through the P&L, because that's the law. And then the accounting. Keeping it simple, PP revaluation is a choice. It's optional. Whereas PP impairment is compulsory. Well, it's a bit of a squeeze, sort of maybe slightly over squeezed there, but it's just about got it in. Let me talk about the one on the right first, because this one's black and white. It's nice and simple. It's dead right. I've written that perfectly right there. The other one, optional, is slightly more complicated than that, but the one on the right is definitely true. If an asset falls in value, you can't ignore it. All right. So if an asset falls in value, you have an impairment. You have to put the impairment through. That's the law. Right, so if you have a fall in value, it's compulsory to recognise it. It's slightly more complicated for revaluation. When you get to your first year end for your first property, then you have an option between what's called cost and fair value. So the first year end of your first property, you have a choice at that point, which is true, you do. It is optional to go for revaluation at that point. But once you've made your choice, then it becomes what's called your policy. And once you've selected a policy, you then have to apply it consistently. So you don't have a choice the second year end, the third year end. You don't have a choice when it comes to your second factory, your third factory. You have to do with your second factory what you did with your first factory. So it's not completely optional, but your first factory at the first year end after purchase, you do have a choice between cost and fair value. You really do. Which brings us to this rather tricky idea. That one of the most important ideas is very simply written, but it's a little hard to read, which is this concept, the concept of the default policy. Have I got enough space? Default policy. Fair value is the default policy. I think I'll just leave it like that. And that's quite hard to read and hard to understand what you're being told there. So what I'll do is I'll just come away from this subject for a second so you get the idea. What we're talking about is the subject of choice, and the examiner has choice as to what policies are being applied by the entities that you discuss in the exam. So he has a choice, not you. And the choice that he always has to make is the choice between full goodwill and partial goodwill. And he has a choice between this or that, and it's entirely up to him, and you have to do what he says. But there's only 2 ways of communicating. If he wants you to do full, he'll say full. If he wants you to do partial, he'll say partial, and he'll never be silent on the subject. But it doesn't work like that with PPE. If the examiner says that the policy is cost for PPE, then the policy is cost for PPE. That's easy enough. If the examiner says that the policy is fair value, then it's fair value. But if the examiner is silent on the policy, you're expected to know that, oh my word, cost is the default policy. Maybe I should have written the rest of it. And the reason that cost is the default policy is because of what you're just seeing on depreciation. Depreciation, you take what you got and divide by what you got. And you know, the bigger the carrying value at the top, the bigger the depreciation. And what we're talking about in the examination all the time is big PLCs, essentially, made up big PLCs, but big PLCs. And they're always trying to maximize their profit. And clearly, you know, the bigger the depreciation, the smaller the profit. So it's absolutely true, actually. The revaluation policy is very, 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 very rare in real life. And everybody does cost, essentially. And I don't exactly know how I feel about this and the way that the examiner examines it. He expects you to know that everybody does cost. So if he tells you it's cost, it's cost. If he tells you it's fair value, it's fair value. But if he's silent, it's cost, and expects you to know that cost is the default policy. So if he's silent on the policy is cost. You don't have to guess, you know, because that's what the examiner does. That's what everyone does. And that has an effect on this question. This next question, which I'm going to do after a break. So that's great timing. Gives you a chance to have a little think about that. We'll take a break, and when we come back, we'll do a little question, which is actually examining that point. Enjoy your break. I'll see you in a moment. Enjoy your break.